here's the thing about it, right? People don't get this part. Bitcoin is math, but it's a type of math. It's like base 10 math. The Bitcoin protocol is a protocol for money. Now, I hand it to you. You can either say, great, this is the dominant protocol for money. This is the winner, and I'm going to buy as much of it as I can. Or you can keep trying to commercialize base 16 math. There's no reason to think it doesn't last 1,000 years. It could last 10,000 years, right? And that's the part that that people don't get.
Bitcoin is simply that, math. Think of other assets that you can count on to be here in 1,000 years. You should probably be doing some more research on Bitcoin right now. With all this monetary debasement and banking failures, you definitely need to learn more. Crypto family, welcome back to the channel. In today's clip, we'll be checking out the former CEO of MicroStrategy, Michael Saylor, who just recently bought more BTC. They hold over 100,000 Bitcoin on their balance sheet for MicroStrategy. He's going to be talking about what just happened over the past year, talking about the banking failures, the crypto failures, really breaking down exactly what happened. Highly recommend you guys listen to this. I know this is a long clip, but he gives his thoughts on what just happened and what he believes is going to happen next. And it makes a lot of sense what he says here. So I'm going to be playing the clip for you guys here today. Like I said, it is a long one, but I do recommend if you have some time, watch it to the end. Let's go ahead and check out the clip here. Leave your thoughts in the comment section below. Let's go ahead and play.
Pull the clock back 12 months and we'll just rifle through what's happened. This is, of course, my perspective. But one, we start with a crisis of confidence in crypto derivatives, and I called Terra Luna complex. That was a very complex derivative constructed, and it crashes. Two, you have a crisis of confidence in crypto banks like BlockFi and Celsius. People find out that maybe they're riskier than they thought they were, and they melt down. Three, there's a crisis of confidence in crypto hedge funds like Three Arrows. First Three Arrows, eventually Alameda. And we think these geniuses that are smartest guys in the room aren't so smart anymore. Four, there's a crisis of confidence in crypto trading operations, OTC desk like Genesis, and people that are in the business of borrowing and lending out or rehypothecating Bitcoin or other crypto assets find themselves again on the wrong side of these trades, and they're wiped out. Five, there's a crisis of confidence in crypto exchanges. FTX is the most notable example of a meltdown, but generally there's just been massive pressure coming from the regulators on all the crypto exchanges, and we see the pressure placed on Coinbase, the pressure placed on Binance, etc., and that's created concerns, uncertainty. Six, crisis of confidence in crypto staking. You saw the SEC action against Kraken and the ETH staking pool, and Gensler has said staking is a security, and so there's a question of where does that sit? Seven, there's a crisis of confidence in crypto securities. Anything based on a proof of stake token. If you've got a set of founders that are economically interested, that have an excessive amount of either economic interest or governance control that's undisclosed, that is a risky place to be. There's crisis of confidence there. 8, this crisis of confidence in crypto settlement networks. Silvergate and Signature were the two major mainstream settlement networks. When Silvergate fails and Signature gets shut down, the question is, how do we settle on fiat rails? Big question mark. 9, crisis of confidence in cryptocurrencies. And here I refer to stable coins like BUSD. Obviously we saw what happened there. It gets attacked. Custodia gets blocked. Circle, has the mishap with Silicon Valley Bank. Tether has been under pressure. 10, crisis of confidence in crypto regulators. People people don't have confidence in the regulators, right? On one hand, we know they're hostile. On the other hand, there is no framework for registering a digital exchange, a digital security, a digital token, a digital commodity. So even though there's the thought that, well, we just got to register, there's no way to register. And so there is no framework. And then there's stress and there's tension between the regulators. between the SEC, the TFC, the CFTC. There's tension between the Department of Justice. There's tension between various regulators in different countries. Big question mark. It's like when your parents are fighting, right? It's like, how do the kids have anxiety? They got to go to counseling. And then 11, there's a crisis of confidence in the crypto lawmakers, the policymakers, right? There was a move to put forward legislation last year, like the Bozeman-Stabenow bill, and it just kind of imploded. And so crypto lobbyists, crypto lawmakers are all in disarray. That is the micro crisis of confidence in the crypto industry, and that's been playing out over 12 months. Now, that we all know that story, but I felt it was important to lay that out because the thing that's enveloping it right now is a mainstream crisis of confidence. And I think you could trace it. You could say the early sparks were last year. Late last year, the Bank of Japan lost the peg of 25 basis points on the 10-year Treasury in Japan, and it floated up to 50 basis points, and that was a spark. And then we saw the 30, 40, 50-year long-dated bond in the UK. They spiked up 100 basis points or more. Big UK bond meltdown, I guess, in Q4. And the result was the Chancellor of the Exchequer lasted a few days. The Prime Minister and the entire government fell a few days later. And so people were scratching their heads, but that was distant. That wasn't us. That was just on the island of Britain. And so the question is, why would an entire government topple? The Prime Minister, the government, and the head of the Treasury all topple so quickly? And people couldn't quite get their hands around it. But the answer is, when you jack the interest rates up 150 basis points, the bond portfolios with a duration, if you have a bond portfolio with a duration of 20, which is like a 30-year bond, a 100 basis point move causes the bond to be trading down 20%. And so if you have a long duration bond portfolio, 10 to 20, then you're talking about crushing 10 to 20% or more of these bond assets. And that rendered every bank and all the pension funds insolvent, theoretically on paper. And so that just couldn't stand, because they realized they're going to melt down the entire British economy. So we saw that happen last year. That was the warning shot. Well, then Silvergate failed. And it's, when a bank fails, if you can just blame the executive team or scapegoat or say it's a one-off, it's because of incompetence of management or they were in the wrong business, then you can look the other way and there's no mass scare. But of course, after Silvergate failed, then Silicon Valley Bank, started to fail, and that created a bigger crisis. And that was sensitized, and I think it radicalized, if not engaged, all of the Silicon Valley tech VC community, and we saw them get very loud on Twitter. That actually escalated this thing, and then the shutdown of Silvergate it accelerated the loss of confidence in the regulators, and it sort of says, it says that there's uncertainty here across the board, and it injected a slight dose of fear. I think the three in the hit parade of mainstream crisis of confidence is mid-sized banks, right? So the contagion spreads to mid-sized banks like FRC and the like, because they're all holding the same portfolios. And of course, at that point, people start asking the question, why are these banks in trouble? And so we actually see a crisis of confidence in bank accounting, because the reason they're in trouble is because they're not marking to market their assets. If they're marking their assets to market, they all would have had to take every time the Fed raises interest rates 25 basis points, you're going to have a $50 billion write-off by the banks. And And by the time you raise, interest rates 300 or 400 basis points, you would have a $10 trillion, multi-trillion dollar write-off of banks. But because they've got the ability to hold these assets to maturity, they're not writing them out. So now we think, well, we don't really trust the banks, but we also don't trust the accounting. And then Credit Suisse catches fire. And then we think, well, that's a small thing. And then the Swiss National Bank's going to bail them out for $50 billion. Okay, well, you would think that a $50 billion bailout from the National Bank of Switzerland puts that thing to rest. But it doesn't, which makes you think, oh, more than $50 billion got withdrawn from that bank. Now they have to merge it with UBS. Now UBS is afraid to buy it. They want government guarantees. Now the Swiss National Bank has to put up 100 billion in Swiss francs. Oops. If this is that big in Switzerland, if you got a problem of $100 billion in Switzerland, you got to multiply that by at least 10, right? So now it starts to look like $1 trillion problem. Then you get expressions of confidence from the central bankers. So the 6 challenges, the Fed, the EU, the Bank of England, the Bank of Japan, and the Swiss National Bank all agree to swap lines. But what does that mean, right? What that means is that, in essence, the Federal Reserve is going to be sending hundreds of billions and likely trillions of dollars to the other central banks in currency, swapping it for, either posted treasury collateral or maybe even for currencies. And that's an opaque thing. So now you start to see this thing becoming systemic. And of course, that spreads to a crisis of confidence in mortgage-backed securities and agency mortgage bonds. I mean, that's the headline this morning, $8 trillion of them. Right? I mean, obviously, if they're yielding 1.8% interest for the next year and the risk-free rate is 450 basis points, then you would have to be crazy to want to own them. So now 8, and the mainstream crisis of confidence hit parade is we have a crisis of confidence in sovereign debt. Right? In essence, it's a credit bubble. We've got $100 trillion of debt out there, and I don't know what it is, 30, 40, 50 trillion dollars of U.S. sovereign debt, and it's all held to maturity, not marked to market. When you mark it all to market, it's going to be a $10 trillion disappearance. So this is a conundrum, right? Because the central banks, they decide there's too much inflation, so they got to take the interest rates up. And the way that when they take the interest rates up, if they could take the interest rates up without actually marking down the portfolio of bonds, it's like having your cake and eating it too. But but the way you're contracting the money from the system is you're taking $100 trillion worth of bonds and marking them down to $85 trillion. And there's $15 trillion taken out of the system. But if we pretend it wasn't taken out of the system, then all the banks are solvent. But as soon as they mark it to market, they're not solvent. So the accounting of hold these to maturity says I don't have to market to market, but that doesn't work if there's a run on the bank and people just start to withdraw their deposits. So what you have in essence in rapid succession is a crisis of confidence in mortgage debt and sovereign debt, and then just in the bond market in general. Right? How can you have confidence in any fixed income asset? And as I pointed out, that leads to a crisis of confidence in the bank accounting, and that leads to a crisis of confidence in central bank policy. Like maybe the most important chart, Scott, I think, is the 5-year chart of the 1 month or 3 month T-bill rate. And if you look at that chart, then of course you realize that it kind of was 180 basis points, 6 years ago. They took it up to 250 basis points, broke things. Then they brought it back to 100 basis points in January of 2020. And then they crashed to 0 basis points or something like that in March of 2020. And then we were at 0 on the floor for about 18 months. And then we went into a steep climb from 0 to 475 or 500 basis points or the like over the next 12 months. And of course, what you're doing when you take it to 0 is you're inflating the credit bubble to infinity. And then when you're pulling back on the stick of the airplane and you're taking it from 0 to 500 basis points, you're ripping the wings off the airplane, which is the entire economy. So you can't fly a $500 trillion economy like some Red Bull sports aircraft, without, you're either going to black out, You're going to crash and burn, or you're going to rip the wings off of the plane and black out, and then you'll crash and burn. So there's a crisis of confidence there. But you just to add 12, 13, and 14 to this, there's political party dysfunction between the Republicans and the Democrats, right? Just dysfunctional. All of the. I'm not going to go into what it is. You know what it is. It's they don't get along. And then there's regulatory dysfunction. You have conflict between the judge, the bankruptcy judge in the Voyager case, and the SEC and the Justice Department and the CFTC, and there's just a lot of dysfunction there. And then there's a crisis of confidence in political leadership. So there you go. A mainstream crisis of confidence in a $500+ trillion economy, a micro crisis of confidence in the crypto economy. A year ago, all these things were kind of under the surface, and they've all kind of come to the surface in the last 12 months, and every one of them's been brutal. What's happened in the last 2 weeks? Massive Bitcoin rally. Why? Well, I think that if you just put all that into your synthesizer and you say, what do I trust? What am I willing to invest my money in? Where's my safe haven with all this anxiety? And the safe haven is simple. It's Bitcoin the asset, Bitcoin the network. Right, those two things are your safe haven. Bitcoin, the asset, is the safest currency, the safest investment asset I can find because it lacks counterparty risk, and because all of the 11 meltdowns I mentioned in the crypto market, all 11 of those catastrophes have not stopped Bitcoin from functioning. It has survived them all. And so I sense in the crypto community, Scott, a grudging respect growing over the past 12 months for Bitcoin. If you roll the clock back 12 months ago, there are a lot of people that just, the trolls said, oh, it's boomer coin. I'm not going to say who, but many people said it will be irrelevant in 5 years. It's the last thing. It's aged tech. And I think that what they realized is that when there's infinite money and the regulators are not active and the politicians aren't noticing you, then you can have a lot of fragile structures. We had a lot of fragile, overly complicated Rube Goldberg devices in the crypto industry, Terra Luna being the most famous example, that they kind of flew, and then as soon as there's pressure on them, you just realize they're unstable. They're too complicated. Maybe they're good ideas, but they're implemented in an unstable fashion or irresponsible fashion or non-compliant fashion. And when scrutiny comes to them, they're going to collapse. And all of the bankrupt entities, right? BlockFi was a good idea, but it was unstable. Celsius, unstable, right? All these things unstable. They all collapsed. But, in their defense, would be all fractional reserve banks, right? If you're collecting $100 billion in deposits that you have to deliver on 1 day notice back to the depositor or 1 hour notice, and if you're turning around and lending it out for 30 years and a fixed mortgage rate security, that was a bit fragile. And of course, if you bought bonds with it that had a 10 or 20-year duration, that was also unstable. So what we're seeing is a lot of overly complicated schemes to generate yield collapse under this kind of stress. So I think people realize maybe Bitcoin's not such a bad idea, like no yield and no counterparty risk. And, Satoshi's not around to embarrass us, right? I mean, there's a point to this, which is if there's an attack surface, whatever it is, whether it's a founding team, whether it's an entity, whether it's a corporation, whether it's a yield protocol, all these attack surfaces, if they can be attacked, they will be attacked. So I think that if the question is why is Bitcoin rallying, the answer is every other idea for investment seems like a pretty bad idea right now, Scott. And everybody that understands Bitcoin really well, that also had their money in altcoins or stable coins or other investment ideas, or they're if you're a crypto VC or you're a stable coin holder or you're a whatever, you're thinking, well, that is more risky than I thought it was, and it didn't work out as well as I thought it would. And so what do I know that I can run to in times of stress? It's Bitcoin.
For watching all the way to the end of the video. If you found any value, make sure to hit that like button. For exclusive Bitcoin Bros content, make sure to check us out on YouTube. Click that join button. You guys can get access to some of our exclusive content. But like always, my name is Aaron from the Bitcoin Bros. I'm out. I'll see you guys in the next video, and have a great rest of your day.